So this is our first time for this roundtable.
So I had a good discussion with TCM yesterday, and he's very bullish about certain sectors. And Vikram is also very bullish, but I'm going to let them take the stage here. And we're going to first talk about the B2C space in FinTech. And TCM, we would just like to know in the Indian B2C space, how are wallets taken off? What is your idea of the entire transaction ecosystem? What is the challenge in the various uptake of certain services like credit enhancement, discounting, such services in B2C?
So we see a lot of noise and a lot of money that has gone in, but this is in very early stages. The way wallets took off, just to give a history, largely it started out with top-ups, right? Whether it is Paytm or Freecharge, all of them started out with top-up. Freecharge actually converted that into marketing, right? But or MobiKwik again, possibly they moved more into transactions to start with. But if you see the existing players who are the banks, like PayZapp and others have also come up. And if you, from a payment perspective, India is not a credit country, right? There are only about 20 million credit card holders with 30 million cards in the market. And if you look at debit cards, people have started using. There are more transactions, but it is still not overtaken by volume. It's not overtaken credit cards yet by value. The next one we thought wallet would be, but actually it's going to be much more beyond wallet. Now all banks are coming up with their wallets. Every payment bank has to make money, right? For making money, they will move towards transactions, so consumer transactions. But India will move heavily into digital payments going forward. Government is actually coming up with a lot of initiatives where they will move common man to move more and more towards digital payments because mobile is the most penetrated device. But wallet will transform itself when people can actually take money from, like IMPS is there and there is a UAP which is coming, which is going to make it even more easier. So I think wallet will be a fairly, wallet or UAP put together, any payment instrument by a bank is going to be a highly fragmented space, but will be a very large volume, very large value play going forward as well. But how much somebody can make, it has to be even less than the debit card because the cost of servicing a transaction will have to keep coming down for merchants to start accepting it much more, right? Ideal scenario is when a kirana shop and an auto driver can accept payments on the wallet. But one of our companies, Momo, actually now in Bangalore, auto guys accept for payment. Momo has got a wallet of its own. And also in the Nice Road, people are paying their toll by using it. So these are the things that will come up. Transaction values will have to come down in these things. Credit card average is about 2,400 rupees. Debit card is closer to 1,000, 1,200 rupees. A wallet transaction average ticket size will be even lower than that, right? So it has to make sense for the smaller merchant to be able to pay a commission, and because there is no risk attached to it, money, there is no issue at risk that is there. These have to come down. Debit card interchange is 1%, this will get even lower than that because of competition. That's my view on the wallet. You have another?
I think it's sort of similar view, but I think it's important to analyze causality of why wallets took off. Because they did. Right? Wallets have not worked anywhere else in the world. So that's so it's a peculiar set of circumstances that wallets took off in India versus anywhere else in the world. Anywhere else in the world, wallets primarily have been used for a transport use case, more so than anything else. If you're linked to a transport use case, wallets actually work. In India, because the payment infrastructure was poor and all the transactions were happening on mobile, both the number of hops and the way it was structured in terms of processing the transaction, the failure rates were too high. And for high frequency transactions, right, the wallet actually worked because it was an artificial store of money. You would keep it somewhere and you could access it frequently in order to make transactions that were frequent for you. Because the existing payment infrastructure did not work well for those transactions. And everywhere else in the world, because the existing payment infrastructure as well as the network infrastructure was good enough for you to complete transactions, you didn't need it anywhere else in the world. Right? So, like CCM said, because wallets are actually an artificial store of money, right? Whenever you have to change behavior of people who get salaries, put them in the bank, are used to accessing it from the bank and spending it, and you want them to change that, you have to give a very large value proposition. In India, the value proposition was you'll be able to access it fast and pay for it, which your normal banks were not able to do. I think the difference is with IMPS and UPI and what they're trying to push, that you'll be able to access your money in the bank as fast as you'll be able to access the money in the wallet. And if that happens, then the wallet is under threat. I think that's
absolutely, and that's the reason Paytm has gone for a payment bank.
Yeah. So which is the big movement that you will see in sort of B2C wallets and sort of.
Which is the big boys game that we talked about with banks.
I have a slightly different view on whether only banks will dominate, because I think if you see how much the digital goods payments is happening, right? Both sort of physical good payments and digital good payments are happening, we think there is enough space for both acquiring side players. So we've made one investment in a company called Razorpay, as well as M-Swipe, both which are on the acquiring side and the payment side, and potentially even issuing side. So for sort of like Momo, which is on the issuing side, but taking advantage of this new payments infrastructure.
Actually, acquiring has to be many more players.
Yes.
Because acquiring, just to give a perspective, there are about 600,000 merchants who are terminalized as of today. With more than 1 million, because on an average, each merchant has got 2 terminals, right, as a defense. So what typically is expected to happen, this has to reach some 3-4 million locations where it can get accepted. So it has to grow by an order of 8-10 times, right? For that to happen, somebody should be, merchant side acquisition cannot be based on a telephone device or even a, let's say, a Square type of or M-Swipe type of reader. It should be able to accept a credit, debit or a UPI or a wallet, anything, right? And that's where you can actually see a app-based acquiring that will take place. So acquisition players, there has to be, merchant acquiring has to be many more aggregators who are there. Because on the issuing side, when it is fragmented, merchants are anyway fragmented, somebody has to aggregate.
Coming to the lending side, what do you think, what will happen to the services in lending such as credit analysis, KYC, P2P lending, crowdfunding? What's your take on that?
Yeah, so again on the lending side, so at least for us, we think that our maximum investments in fintech will happen on the lending side. Right? That's a sort of macro view that we are taking. We made one which we have not announced. It's in the personal lending space for consumers to buy consumer durables. And we are going to do a lot more on the lending space. So again, in the lending space, I think it's important. Every lender does 4 things. Right? They source a loan. They figure out what kind of people they want to do, and they source a loan. Second, they perform credit assessment and assessment of risk to understand what the interest rate should be. They figure out how they can collect the loan periodically, and then they figure out what their balance sheet should be so that they can do more and more loans. So everybody does 4 things. Now the question is, which of these 4 things can you move online, and how fast can you move that online? Because if you move it online, the theory is that you grow faster, and therefore your company will come up faster. Right? Now, we believe any of these 4 can be moved, right? And therefore, very different models can end up, right? So we have, for example, a company in our China portfolio called FinTech and QFinTech both, which actually do a lot of their sourcing actually offline, right? And they do a lot of their sourcing offline, but they do all their credit analysis online because they are actually analyzing all of their social data. So they did this very well for students. So they would go to different colleges, and they literally do physical camps in colleges, but then analyze their WeChat account, their Sina Vivo account, their marks history, where are they getting placed, what are they doing, all of that, and actually make a credit assessment online, right? And the balance sheet also used to be online because like anybody, any HNI could sign up and say, I want to lend to these people, but the collection was offline. So you can have different ways of doing this. On the other hand, you have someone like Lending Club, where they have everything online, right? Which is actually at the extreme, where sourcing is online, credit assessment is online, balance sheet is online, and collections is online. But that needs a very evolved ecosystem for that to happen. From our perspective, we think that India is not ready where everything goes online. You will actually have to do online-offline type models in order for you to actually be a viable sort of lender in the country. So I also sit on the board of a completely offline SME finance company, and we are already seeing how we can actually take some of those things online. So I'm happy to talk more in detail if people have sort of questions, but I would sort of say that's sort of at least the framework and thought process by which it will be thinking.
Yeah. So now our view is that India is highly underpenetrated both in personal finance, whatever form of individual loans, PL, home loans, other things. Also in SME is a sector which is highly underpenetrated. So these two put together, in the next 4-5 years, the lending quantum is supposed to be at $1.2 trillion. It's supposed to grow something like 30% per annum. These two. And banks actually, most of the big banks are still nursing their balance sheets. But there are enough and more aggressive non-banks. And they are doing an amazing job in terms of speed, what needs to get done. Actually, SME lending is moving more and more towards, algorithm, formula-based, being treated more like retail. Right? So these two we believe will move online in terms of sourcing, depending on the pace at which. But assessment for SMEs is going to be a very interesting challenge, right? Because that's the reason why banks are not focused on. In addition to the fact that there is a lot of cost, all this will move online now. There's a lot of opportunity which is coming. Just to give an idea, because banks have not done a great job in SME lending, you'll be surprised to know that there are enough money lenders who lend in this market. In fact, I was talking to somebody and I was shocked to hear that number. And in Bangalore, daily lending, which happens in terms of P to SME, which is called P2P because end of the day, the borrower of SME is the proprietor or the managing director of a limited company, is about 100 crores a day. Right? And Bangalore is not a big market for lending. Right? Assume 20 days a month, it is 2,000 crores of lending that takes place in Bangalore, and which is significant. And if you add, I don't think banks together are lending 2,000 crores in a month. And these guys know how to even recover the complete process, and this has been going on for generations. Like there are certain communities who actually have made life living out of lending, right? And these people have been doing it for a long time. These guys today they have risk of, in a smaller community they are lending, in a smaller network they are lending. Possibly they run the risk of either an industry or a city or a location. When it is going online, these guys can very well go online and then lend, diversify their portfolio. If a sourcer can also do an assessment and provide a rating, you will find it a very interesting play. So we are investors in a company called Credit Mantri, which focuses on people who don't have credit files, so that means you don't have a CIBIL score. Because you never borrow, which is actually make sure that you cannot borrow again from the bank. Right? So unless you have a CIBIL score, bank is not willing to lend to you. And these are guys who actually are building surrogate scores based on various other things like social and other things, and create a marketplace on the other side, banks, NBFCs, and progressively, I believe that P2P lending will happen.
But there are a lot of regulations around crowdfunding, P2P lending.
I think it's a very gray area. There aren't actually very many regulations around it. If you ask me honestly, it's not like one of those which actually say this can be done or this cannot be done.
Yeah.
So everything is sort of in the gray zone. Right? I think if you go to the regulator and ask, can I do this? The usual answer you get is no. So don't ask. But if you get to do, then you can actually get to shape the regulation. Right? And honestly, that's what Paytm has done. Right? Can you go and ask, can I do this? Can I do this? If you keep asking, they wouldn't have allowed them to do anything. Right? But if you actually end up doing a bunch of things, then you get a payment bank license, then you can do if you want at the extreme. Right? So, and just going back to what DCM was saying, so for example, in M-Swipe, you actually launched POS loans, right? Because the easiest thing that to do is, so they have about 60,000 terminals, which are their own merchants and they own the data. So because of the data, you can like you said, the app actually comes up as a branch, and you're offered a loan on the M-Swipe app, and they say yes, I want the loan. It just analyzes what your payment volume has been on a daily basis, and calculates the EMI in the back, and says you're eligible for 20% of your daily payment volume. That's the EMI, therefore you're eligible for a 5 lakh loan, and it immediately just processes the loan. But there, you have both HNIs, and actually surprisingly some banks who are actually taking that data and just lending.
So Neo Group is doing
Well, new growth is actually sourcing the borrower first.
Correct.
They source the borrower first and they assess the borrower and then they decide to give the personal. M5 actually sources them for a payment, and they are on our, so we only do this with people who are more than 6 months.
Right.
So the objective of M5 is not to source the borrower, is to source a merchant. And then once you have enough data, then you can actually lend to the merchant. So whereas new growth is actually using
existing merchant network to.
No, so new growth also uses M5 terminal. So we know what new growth does is actually they're using M5 for collections because collection cost is 0 because they just swipe the debit card, you don't have to send someone. So new growth is using that to say you will cut collection cost. But the sourcing and the credit assessment, like you said, they still have to do a lot of work. Whereas if you now there is a lot of data available. Like FineLabs has also started the same thing, right? Where you got personal. So as more and more digital payments happens, right? We are sort of building the infrastructure where all of this stuff is possible.
So I have a question on credit assessment, right? And I think before recently, both you guys brought this up, right? I mean, when you talk about credit assessment for an SME, in some ways you do have a large pile of data currently available. Whether it's through online transactions like Capital Float or through your card-based transactions, which is new growth and stuff. So, what is your perspective? When you talk about companies in China sitting and evaluating alternative credit scores for students, right? Or the credit X or the credit karmas of the world. What is your perspective on alternative credit scoring for consumers? Because currently it is the holy grail of every NBFC can expand their borrower base in a profitable way, right? Which means assessing thin file and new to credit customers in an effective way. But what is your perspective of that?
I mean,
And which players would you see capturing this market?
Yeah, so it's a great question because actually so far in the country, no credit assessment has ever been done. So there are no, and it's a pretty strong statement to make, that's what I mean. So because so far NBFCs have actually been collection agencies. So it's a collection-led NBFC model. I know where you live, I know where you work, therefore I can collect from you, therefore I will lend you. Right? That's sort of the model. And that is, I'm taking it to an extreme to make a point, but that's basically the model. So it's not as much, and I'll check some civil score, I'll do something, and that's it. Right? So people haven't innovated around credit assessment. Right? So if you go to the US, Capital One would have made very sophisticated models where they'll say 4% NPA is acceptable in this near subprime segment, and therefore I can lend to that. That kind of stuff no one has done. Right? I would say the one person who's probably done a little bit of that in finding is Bajaj Finance, who's done some amount of modeling in some respect, but nobody else has done that modeling. Right? So in order to do any of that, the data set should exist.
Sure.
Right? Lending Club, the data set actually exists. Here the data set doesn't exist.
So do you think it's lack of data set existence, or do you think it's a lack of technology to tap into that data set that exists?
So I think the first is actually, we have one company which is actually doing something in the student finance space, right? Which is in the student lending and how to assess students and so on.
This is in China, the one you mentioned?
No, we've invested in one in India, we haven't launched it, but we have invested. So the first thing is actually to create that data set into a format where you can actually analyze it. Right? That just doesn't exist, because even if you're trying to lend to a student by just looking at this Facebook page and how popular they are, it's a hard assessment to make of whether they should be given money to buy an apple.
Sure.
So then you need sort of more data in order to say, and that data needs to be retrieved. So today, most of the companies which are trying to do that, and lots of companies are trying to do that, are actually coming up with I need to create the data set problem. Much more than, whereas, which is why, in the colleague's slide, it said, all of these guys have taken off in the US, and India is slow to take off. It's much more that the data set existed, and they started immediately running the algos and models. The models also existed, they just started running them quickly, and then these things just exploded and took off.
Sure.
Whereas we need to create some of those data sets before some of these can take off.
But in India, a lot of data sets are available, right? For somebody to actually have an imagination to be able to connect these dots and create the rating, I don't think the civil experience of the world are going to.
Sure.
It will be done by private enterprises funded by company funds like us.
Sure.
Right? People are looking into it. I'll give you a data point, right? India is 97% plus prepaid. Does anybody know how much is the prepaid rate topping up? If somebody is topping up 300 rupees or 500 rupees a month, right? That's a surrogate for us income stream.
Correct. That's not like venture in Africa, like first access.
So those are the things that today people are not even thinking about, right? And this is just one sliver of information. There is a whole lot of other information that's available in the system that people are now trying to put that together, connect the dots. And so what is a vendor looking for? It's looking for a need, right? Which possibly will be supported, say, I'm buying an asset or I need a bigger and things like that. Second is ability and intent. If these three are satisfied, then they are willing to buy.
Sure.
Right? Ability is still not established properly, and intent is not. Intent will be done through social profile, right? And ability will be done through other surrogates which are there in the system.
So if I were to ask you to spill your secret sauce with your investment in Credit Monthly, would intent be the part that would be captured by?
No, both they have to assess, right?
Okay.
So ability to the banks, like for example, so what does a typical bank do? They ask you for a 6-month bank statement, right?
Yeah.
They can use it minimally, saying that okay, fine, I know that this guy has got a bank statement for 6 months, which is what most banks are doing today. Have they passed and seen your expenditure pattern? If they start doing that, it's very rich, and they don't do it, which is what these companies do.
So, for example, even your email has the information, right?
Yeah.
How many reminders do you need to pay your credit card bill? It's a good indication of how you think about your finances and what you do. So if you're someone, and you know, people are trying to scrape some of this when you log in with your Gmail, when you log in with your Facebook. That's what people are actually going after, which is how you're dealing with some of these and what is the frequency of purchases, or what is the frequency of your payments. That actually has the largest amount of data.
Do you think public sector banks would buy this and view them as like a valuable partner? Companies like this.
You don't need public sector banks. Like you said, today if you go to a Magma, today if you go to an Finance, today you go to a Shriram, today you go to any of the guys, these are all these are $5 billion companies, right? These are huge companies. They are willing to do it. You don't need them, right? And their cost of capital is 11%. If you find something there, you are able to do it at 18%. Sure. You can convince them easily, no problem. And
Yeah, public sector banks are busy fixing their balance sheet. I think it will take another 2-3 years.
Yes, yes. So you don't need them, right? And here you can walk in, you will find people who are very financially savvy, very young, going after digital in a pretty hard way. They have the digital jobs to build a digital product, right? But they are very open to actually partner.
Thanks.
So if I were to actually now pivot around.
So I think we also have.
Oh, please go.
Sorry if I may.
No, no.
So I work in a bank, and yes, you are right, absolutely, that we are nursing our balance sheets, and it will take a little while. But what has happened in this whole process is, if you look at the balance sheet of most of the banks, I don't work for a public sector bank, I'll tell you the story. Most of these were towards the corporate portfolio. So over the last few years, these banks have gone or are going vigorously at the consumer side of it, whether it's infrastructure, investment, digital, whatever way. So my queries are two. One is, now you will see a whole lot of pool, which was hitherto attracting these guys, but not there aggressively, coming into that space. You have the payment banks coming into the space. You have the NBFCs coming into the space. And then you have these FinTech companies right around this. My query is, will credit be compromised by at the FinTech level? One. Two, one of the essential things of these banks are, where do you sell down your loans? Which is again a factor of how the credit worthiness of that loan is. How does FinTech startups, the ones who are there in that space, look at progressing on that front?
Yeah, so I think that's a good question. So at least payment banks can't lend, so they are not a player. But for the rest, they have to come in. They will use some of these methodologies. But to sell down, there's a lot of money that is sitting in pensions and insurance and all those places, which is completely not unlocked. Right? They are all going into today by default into government paper. Right? If that has to get unlocked. Even otherwise, my belief is that if there is decent credit available, you will find people coming from outside and then buy these papers. Which is provided this rating is found to be good. So people have to first go through their balance sheets in their own ways, and they're within the existing levers, not about selling down notes to prove a few cycles saying that these things work, right? So you get a 1:10, 1:8 leverage. Initially, the magmas of the world have to do that, or Bajaj Finance has to do that. After that, they will be able to go and say that, okay, fine, now I can actually convert them into notes and then sell in the marketplace. Will credit be compromised? In any competitive field, it's finally left to the people who are disciplined not to compromise and people who are aggressive to get compromised. So the same banks which have been, some of the most aggressive banks, in 2008 had a significantly compromised personal loan portfolio and retail portfolio, which they had to take time to fix it. And that's made them actually lose their leadership position, right? And so that will always happen. So in VC industry, we see in euphoria people will pay up and then they will have to pay some amount of price in terms of either digging out valuation or sometimes backing not so successful companies, right? So that will always happen in any open market. So one needs to look at the discipline of the people who are.
And I think it should happen, right? Because we don't have availability of credit. So I mean, right now we're just talking about boosting credit discipline to the next degree, and I think there is enough where you can make a lot of money, and NGs might be a little bit higher for some period of time or some players, but I think people will figure it out.
There's a lot of scope in asset reconstruction, so like 5 years, 10 years down the line, in startups.
Yeah, the only other thing that I would say is that I know that so if you look at China, 20% of currently a person's savings or investment is actually going in B2B lending. Right? So it's a staggering stat. Therefore, it's the most important place where they actually do lending. So they are actually, we don't actually need all the papers and so on. At an extreme, you can just go pass through from people who actually have disposable income to say, I want to lend at 17-18%, and they do their own portfolio construction and so on, right? And which is what is happening in the US as well. So the fact that it has to go through the bank, right, is not necessary.
So what is the profile of these lenders and what is the profile of the people to whom they lend? If it is 20%, it's a large sum.
No, that's not true. So today, if you actually are a small SME, you can actually expect to get a loan between the 16 to 20% range. So, for example, even if you're a great seller on Flipkart, for example, I know for a fact that number one seller on Flipkart on consumer durables and mobile actually gets a loan at 16%. So I know all of us with the credit history and that we have, we're used to the 8, 10, 12% type range. That's not what the country borrows at, for sure, right? So even today a CV loan by, let's say, a HLF with the prospectus is 16%, right? So
no, I'm saying, what is the profile of the person who is lending the money?
Today, it is actually
in China, if you're saying that it's 20% of the total savings.
No, China is a normal person, right? My partner is in China lend, right? So it's a normal person. Anybody who has.
And they will lend to what kind of people? These kinds of SMEs.
They come on the network.
It will come up on their screen. They usually like this. So, for example, my partner in China tells me, anybody who is going to my college, he does a lot of the student finance stuff. Anybody who goes to my college, I look at his grade, and I usually know if he's got these good marks, he will put that. And that's what he does. So that's, it's at a very evolved stage in that market.
But in India today, P2P is taking place in different forms. I have met companies. There's a company which is payday lending.
Yeah.
And you will be very surprised. The profile is, IT, BPO people who go for a payday lending.
Yeah.
Right?
They lend.
No, they borrow.
They borrow, right? Because they know that it's a very short-term requirement. If they go to a bank or any other place, it takes 2 weeks to process. By that time, he is going to repay.
Yeah, my mother went to the hospital and I can't make this payment. I just want to go and get 25-30K to meet this immediately.
And the interest rates are crazy, right? It's the same thing like the old Patan would have possibly stood outside the factory gate and taken interest.
And will they get their money back?
Significant.
Yeah.
Really?
Yes.
Because the experience of companies, even in regular things like IT and BPO companies, on even simple things like attendance and their it's been very poor. They just vanish and they're just not traceable. I mean, companies are struggling with that. How do you trust such kind of people to lend?
Yeah, so they all have. So there is a risk profile that they take, which is priced into. So it may not be a classical 1% or less than 1% NPA, right? It may be a 4% NPA, but it gets priced into.
And Bonga at an extreme, which was the largest payday lending company, at some point in time used to have 8% NPA. But their IRR was 50%. Right? So they didn't care about the 8%. 8% of people or 8% of loan value are default. Right? So it's not like, but their IRR was staggering, right?
Yeah.
So, and there is a risk return trade off.
And in India today, people are willing to borrow at such rates.
So if I were to just sum up this,
They are willing to borrow for what they feel it will not be accessible.
See, only for people who have a longer term borrowing, the IRR matters. For somebody who borrows in short term, extremely short term, right? Let's say I am going to repay in 2-3 weeks. It's only what points I pay. Nobody multiplies by 12 and sees it. Nobody says that okay, if I'm returning in 3 weeks, my average tenure is only 1.5 weeks, so I am paying so much. Right? This is completely myth. That thing looks at just the transaction cost. Right? You go to let's say a vegetable vendor, they borrow 1,000 rupees in the morning, and they are happy to return 1,100 rupees back, right, to the lender in the evening. This is very standard practice which has been possibly going on for past 2-3 decades.
That's 10%
10% per day.
Yeah, but that's 3,000 rupees of IRR for the year, right? If you were doing it at a company level. But the 10% for the day doesn't really matter to the person.
No, but so when I have talked to a couple of companies in this space, and so I have come to know that the purpose of taking those loans has been either debt consolidation or a business purpose, which cannot be a very short term. I think it will be anywhere, 12 months, 18 months, 24 months. So in long run, looking at the rate of interest, I was talking to one of the guys who was saying weighted average is coming 21%, 22%.
So it depends on people, right? For example, if you go to the sellers on Flipkart, now they've figured out that this is the working capital loan cycle that they're going to get into.
Yeah.
They do that calculation. And they immediately, 16 to 18%. If you can lend at 16 to 18% to our sellers, come on the platform, otherwise don't come on the platform. Right. So there it starts, the route.
But maybe the volume will be very high on a smaller transaction ticket size. But if I look at the value wise, do I see a scalability coming very soon into this business?
So even in debt consolidation and all, actually it makes sense, right? Instead of actually screwing up your credit score, if you are able to take something like this and then repay your EMI or something like that, which is overdue, people are calculating, saying, okay, now I am paying, let's say credit card, if I am overdue, I am paying 30% interest.
Yeah, I think
So this type of alternative,
yes, then it makes sense.
people today take conscious alternative decisions.
Yeah.
Right? And in businesses, while you'll be very surprised in offline, right? Established supplier-vendor relationship for many years is going on, and then every time 33rd day they get paid. It's an MNC based base. You go ask their vendor saying that if I pay you in 1 week instead of 5 weeks, what is the extra money that you are willing to borrow? Right? It's 4%. Because if he is not getting lending and if he is going to get a leverage like this, he is going to just jump at it. And the cost of recovery, because 33 is not guaranteed all the time.
There's just such a paucity of access to capital for businesses, for just working capital. Right? They are always calculating what is the extra growth I can get with this. Right? So if your return on capital, and most of the small business returns on capital is like 30%. Right? So he's looking at that if I take this money, I grow this much and make this much extra cash. So they say I'll take the extra cash and make money.
But basically, if you look at
can we just
yeah, okay, so one response. So if we look at P2P thing, so currently, even if I'm taking a loan from this kind of a platform, I may not get recorded into Civil, but in future it will happen, right? I'm assuming that this has to come.
It can.
Ultimately, how do you track? Otherwise, there's a lot of risk in the market, right? So in that case,
over time, all this will get
well, has to get
take time.
So I had a long list of questions which unfortunately I can't ask. So maybe next quarter before we will come to that. Thank you very much, Vikram, for being a part of the debate. Thank you. So in the entire whole research that we did around FinTech, we realized that there were a lot of regulatory challenges, and Abhinav, who's an associate partner at KLaw, actually held our hand and led us through it. So we decided to have him be a part of the panel along with Mr. Chandy. Chandy is a partner in Ernst & Young. He's in the tax and regulatory services. He's also a chartered accountant, and he has addressed several forums in India such as ASSOCHAM, NASCOM, ICA, and the Chamber of Commerce and Business. He works extensively with companies in the technology space, has a special focus on companies in the startup and growth phase. So what we'll do is, in this case, we'll just have a 20-minute conversation, and then we can have the question and answer session. So the first question that we wanted to ask you is, Mr. Chandy, what are the current trends of regulation and the way RBI and SEBI has been responding to startups who are demanding an opening up of the space, especially in the fast-growing sectors such as wallets, payment gateways, and lending?
So it's a fairly loaded question to start off, but what we are seeing is RBI is opening up. They're giving multiple approvals, and you see the payment bank, the small banks. On the payment and settlement systems, we had applications in the past pending for 8 months, 12 months. Of late, they have been increasing the pace of their approvals. So the general sense that we get, and this is all in the center and at SEBI, is that if the industry feels that there's a roadblock, which roadblock is fairly illogical, and if you go and talk to them, and they are more than happy to open up regulations and to understand what businesses want. For example, the listing of startups, all of that is a newer happening. So we are quite happy with how regulations are coming about. May not be as fast as we want. RBI still has concerns on, you know what their concerns are, that is the consumer going to be impacted, and what checks and balances are there for consumers. How is the technology robust enough? So subject to that, regulators are have become much more open.
Absolutely, I agree with Chandy. The regulators of late have acted more like enablers than coming up with regulations which are very restrictive in nature. Something as big as a consultation paper on crowdfunding. It's always better to have regulations rather than not have anything and operate in this way. Like Vikram just said, you have an idea and you think it's not going to make a systemic problem for the government. You go do it, and the government will come up with regulations to regulate your business. There was a statement from RBI that they're looking at the lending platforms now very seriously. There are no laws as such to regulate the lending platforms, but now the government is taking note, and probably they'll come up with regulations which actually enable doing the business in a way that you guys want to do it, rather than restrict the business. So yeah.
I hope that the regulations actually start to open up for the guys, especially in the B2B space. So there are regulations surrounding subscriptions, there are regulations around trade receivables as we talked about. But what is your opinion on these aspects which are significantly reducing the scope for B2B players?
I think as was rightly pointed out, the problem is lack of regulation. And with the lack of regulation comes lack of recognition and the ability to monetize and all the other things that financial service entities thrive on. So the P2P players, or the B2B if you may call it, they are learning from the UK experience when laws were not there, and then there was a law, how members got together, how they self-regulated, went to the regulator. So the ask of this industry, curiously enough, is please regulate us so that we can compete with the regulated players. It may seem very strange, but that you really need some regulations to bind people together. Otherwise, one bad apple can sort of spoil the sector.
But specifically with regards to trade receivables regulation, we have a startup here today who's in the discounting space, receivables discounting. What is your opinion about the space actually opening up?
So see, as such, there is no problem with the space, right? It's a lending product. So what the RBI did with the trade receivables discounting system, they tried to legitimize a structure, a platform, where there could be financiers on one side and there could be MSMEs on one side trying to discount their bills. So there's no problem there, right? But the problem is who runs the platform. So in the guidelines that the RBI has prescribed, some things like having a 25 crore paid-up capital and non-promoters, no entity, having more than 10%, no non-promoter entity having more than 10% in shareholding is quite challenging for early stage companies which will thrive on, investors like TCM and Vikram, right? So that probably makes it a huge issue for early stage startups who are not backed by a lot of money on their own to start something like this. So probably if things like those can change a little bit, if they can liberalize it a little bit, a lot more applications can be seen. So I was reading somewhere that RBI till now has received only about 7 applications for the trends, and they have extended the timelines to receive applications till about Feb 2016 or something. So it's a good start, right? It's a good start, but let's see if they can liberalize it.
So the same question that I asked TCM and Vikram, what are your insights on crowdfunding given the amount of regulation in the space around P2P lending, crowdfunding? Because we have 3 startups on LP who have 2 of them have raised funds, the third is in the process of raising. So where is it that we are not able to sort of lobby with the government? Where is it that we are not able to sort of influence them in a way to sort of offer us the right facility?
I think the crowdfunding draft is out, the public comments draft is out. What is lacking possibly is a coalition of players in the space, because it's too nascent. Players in the space to go and talk to the government and say this makes sense, this doesn't make sense. So I think that is what is lacking. If you look at e-com and how it's evolved, when it started off there were so many players, so many things happening, but there was no association. Today there is an association, and they are able to, more than ask for things, they are able to educate the other side. So it's a learning process on both.
So where E&Y has a substantial part to play, I guess.
Everybody. E&Y is more a facilitator. It's the people who get together, who are doing business, whose ideas should not be decimated by regulations. Those are the people that matter. Their ideas matter, but they have to think of how do we get together and start communicating to the people who matter.
That is why a platform becomes very important.
Absolutely.
And there's one thing that we'll have to keep in mind when it comes to crowdfunding platforms is there's a huge change in law that will have to be brought about in order to enable crowdfunding in the classic sense. Something as small as how many people can a private company take money from if it's equity crowdfunding, right? The Companies Act says 200, not more than that. You don't just need the crowdfunding regulation, you also need the Companies Act amended.
Yeah.
So there balance has to be there to ensure that while the intent of formulating the Companies Act in a certain way is not disturbed, and the whole ecosystem also thrives.
In your experience, how this 200 shareholder limit, has it been very painful for startups?
It actually is a good thing if you compare it to the old act which had 50 as a number, right? So again, like I said, that as a country which was actually very, very conservative, it's starting to look to the West and try to, at least we're trying to make regulations which are a little more liberalized, which enable businesses to run in a way that they would ideally want to run.
I think those are the comments to add on that, where the top paper has received so many inputs. And, one is 200, the other is, will you do a preferential issue at all times? How will you get everybody to there? So there are numerous issues, and it has to be on the right point. You have to change, facilitatory regulation. And that's the problem. And that's where policy advocacy is important for the sector as a whole.
You don't even know how much Shanti used to call me just on once the crowd funding people was out, because there is a lot of uncertainty. Who gets covered here, who doesn't. Shanti for some time was I think feeling very, very nervous about it. How do we deal with it? We spent about a week every day trying to come up with recommendations that would actually facilitate the whole ecosystem, rather than it becoming more restrictive.
So are we still in the grey area with regards to crowdfunding, or are we on, we have a side but we have to go a step further?
We are in grey, we're going to be in grey till something comes up officially. Right? So the consultation paper was out about 1.5 years ago. Nothing's happened, although there's media report that probably will come out soon on the regulation.
The problem with these new regulations is, if you take the Income Tax Act, they put it out for public discourse, and then they very quickly withdrew it because the comments were so sharp. So that's the problem in crowdfunding, because they come up with so many issues that they may be forced to withdraw it. And if they introduce it in a half-baked manner, people will get into structures that are not amenable for growth. So you do all sorts of strange things. So we just have to wait and watch. I think the jury is out on whether regulation per se is always good, but jury is out in India whether regulation without considering everything is better than no regulation at all. So we'll have to.
So I would like to just come to the last question here. This has been on everybody's minds at every. What is happening in cryptocurrencies? It seems to be, we don't know whether it's taking off, we don't know what's happening. We know that the rest of the world is very calm about it, but India is nothing is happening.
So RBI has come out and said, be very careful, beware. So that's the stance that they have taken. Now, since they have taken that stance, you have to understand why have they said it, what is their worry. So there is a lot of advocacy required. You have to understand the other side. But generally it is their discomfort with things they do not know. Every regulator, they don't know where this is going. Barter, how will barter work? Is the consumer protected? Is the person who buys the Bitcoin, what is his backup? So that's, I think, the fundamental issue. So if you look into a crystal ball, I think RBI will be, it's far away.
Absolutely. Considering you can't think of a recourse that a consumer will have, like Chandy said, like something goes wrong, where does the consumer go? Right? Your presentation has a very valid point there. It's not going to be recognized in the seal.
Yeah, as a barter transaction. It's going to be a barter transaction.
So where does the consumer go as a recourse? What is it?
So all those things have to be considered. Having said that, India and the entrepreneurial mindset, the more the people who do it, the faster the regulation will come. And the bigger that sector gets, the more difficult it will be for RBI to come and just clean it up.
So, but who would say that, okay, let's not treat it as a barter transaction, or who would say that, let's treat it as a barter transaction, but let's have this sort of a recourse? Where should we start?
I think the starting point is, and Shweta and Abhinav are best people to answer it. Is what we are doing illegal? That's the starting point. If it's not illegal, let's do it. There are no regulations. I think that's how you'll have to approach this. And the more the people who do it, the bigger the sector gets. It's like e-com and everything else, right? The bigger the sector gets, you have to pass regulations to facilitate. That's what I would think.
No, absolutely. And even for startups, wanting to get into a space like this, any investor who's going to come into this space would want. Now we're going into the details of it, but would want an indemnity or would want a straight representation that what you're doing is absolutely in accordance with law. What happens tomorrow if RBI asks you to shut shop? You are under an obligation to return every penny that you've taken from the investor, and rightly so, right? The investor invested based on your representation, and suddenly the money is all gone. So the promoter then becomes personally liable to repay to the investor. So these are things that should be kept in mind before even trying to venture into these
Hopefully none of you are taking money from people who say, guarantee my money. In the startup world, it's the most dangerous one to do.
Alright, I'll just open it up to folks who would like to ask questions.
On the lending side, you see the risk of, when we talk about things like payday lending, you see the risk of the regulator coming down and clamping down on interest rates like they did in the microfinance industry, for example?
See, the risk is obviously there. If there are, usually rates of interest and you start charging 40%, you would have regulations that limit it. So they would. I would imagine if you set your business model which says that you're going to get 40% interest rate, that may not be sustainable. But if you set it saying bank rate is 14, I'm going to do 25%, I think in that range you should be good.
A couple of things which RBI has done of late, we are all aware of that, is one, increasing the liquidity, second, making cost cheaper, at the same time providing capital. Till the liquidity is increased, it's fine. The moment it moves into the regulation with these two aspects and looks at the things with the smaller startups on the FinTech side, do you foresee that to be a problem in the near future, or is still some time away? With the cost of capital, because that's the main profit business, right? Cost of capital is what gets them there. And second is, do they currently have to keep capital aside, or given that there's no regulation on that, do you play it on the cost of borrowing side?
So again, I would think that the sector, RBI may look at it as it's too small a sector to do too much. But there will come a time when you are of a particular size that they will give people time to say you need to keep balances. They will look at you like an NBFC, prudential norms, all of those will come in. But it's probably too early. If you look at the gold, lending against gold is just a classical example. When they got in those limitations of you can't lend more than 80%, 75%, the whole industry in the south was up in arms. 6 months later, the market crashed. And if they had, if they had continued at 100%, all of them would have got wiped out. So the general sense all of us have is that the RBI, in all this grey area, there is some logic, and what they do is eventually right. So the answer to you, I don't know if that gives you an answer, but the answer is entrepreneurs should go out and do it as long as it's not illegal. When it gets to a size, you need to be conscious of what RBI will do, and that your investors will sort of start forcing.
Been great, good chat. Thank you so much. Thank you so much, folks.